When most people start trading with $100, their mind instantly shifts into get-rich-quick mode. They imagine doubling their account in a week, maybe hitting $1,000 in a month, and before long, they're dreaming of quitting their job. This mindset is the exact reason most fail. The $100 in your account isn't just money, it's a mirror reflecting back your deepest beliefs about wealth, patience, and what you think you deserve from the market. You see those screenshots on social media? Someone turned $500 into $5,000 overnight. Another trader claims they made $10,000 in a single day. Your brain starts calculating. If they can do it, why can't I? The answer is simple. You can, but not in the way you think, not with the speed you crave, not with the shortcuts you're chasing. The traders who actually build fortunes from small accounts understand something most never learn. Success in trading isn't about the size of your starting capital. It's about the size of your patience. It's about developing a mindset so disciplined, so methodical, that the market has no choice but to reward your consistency over time. This is the $100 mindset that builds trading fortunes. And by the end of this video, you'll understand why starting small might be the greatest advantage you never knew you had. Most traders approach their $100 account like it's play money, something they can afford to lose, something that doesn't really matter. They risk 20% on a single trade because, hey, it's only $20. They chase every market move because they feel like they need to make something happen fast. This is where every trader's downfall begins. You're not weak for thinking this way. You're human. The market is designed to trigger these impulses. Every tick of price movement whispers urgency into your ear. Every red candle screams that you're missing out. Every green candle that you didn't catch feels like a personal failure. The pressure to act, to do something, to make progress right now is overwhelming. But here's what most traders never realize. That pressure is the trap. Think about the last time you placed a trade out of frustration. Maybe you'd been watching the charts for hours. Nothing was setting up according to your plan, but there was movement, volatility, action. So you convinced yourself that this setup was good enough, close enough. The entry wasn't perfect, but you couldn't stand sitting there doing nothing anymore. You clicked buy or sell, and within minutes you knew you'd made a mistake. This happens because you're treating trading like a video game where action equals progress. But the market doesn't reward activity. It rewards precision. It rewards the trader who can sit in front of the screen for hours and take 0 trades because nothing met their criteria. Most people can't do this. Their hands itch to click. Their minds convince them that any movement is better than no movement, and so they sabotage themselves, one impulsive trade at a time. The illusion of speed is seductive because it promises to solve your problems immediately. Bills need to be paid, dreams need to be funded. Time feels like it's running out. But speed in trading is like speed in surgery. The faster you try to go, the more likely you are to make a fatal mistake. The market will teach you patience whether you want to learn it or not. You can learn it voluntarily through discipline or involuntarily through blown accounts and emotional devastation. Consider the trader who starts with $100 and immediately risks $50 on their first trade. In their mind, if they win, they're instantly at $150. If they win again, they're at $225. The math seems simple, the path seems clear, but they're not calculating the other side of the equation. If they lose that first trade, they're down to $50. If they lose the second, they're at $25. Now they need to quadruple their account just to get back to where they started. This is the mathematics of destruction that most traders never consider. They focus on the upside potential while ignoring the downside reality. The market doesn't care about your timeline. It doesn't care that you need to make money fast. It doesn't care about your bills, your dreams, or your desperation. The market simply reflects back to you the quality of your decisions over time. The traders who succeed understand that speed is the enemy of wealth. They've learned to think in months and years, not minutes and hours. They see their $100 account not as a limitation, but as a training ground, a place to develop skills that will serve them when they're managing $10,000, $100,000, or even millions. But this shift in perspective doesn't happen overnight. It requires a fundamental rewiring of how you think about money, time, and progress. The compounding mindset is the antidote to the speed addiction that destroys most trading careers. It's the understanding that small, consistent gains multiplied over time create results that seem impossible at first glance. But this mindset is rare because it requires something most people struggle with: faith in a process you can't see immediate results from. Imagine you could grow your $100 account by just 3% per week. Not exciting, right? That's only $3 in profit. Most traders would laugh at that return. They want bigger, faster, more dramatic results. But let's follow the math. At 3% weekly growth, your $100 becomes approximately $1,600 in 1 year. Still not impressed? Let's keep going. By year 2, that becomes about $25,600. By year 3, it's over $400,000. And if you can maintain that discipline with larger capital, the numbers explode into millions. This is the power of compounding that most traders never experience because they quit too soon. They abandon the process before it has time to work its magic. They see the small initial gains and conclude that progress is too slow. What they don't understand is that compounding starts slowly, then accelerates dramatically. The early stages feel like you're going nowhere. The later stages feel like you're traveling at the speed of light. Warren Buffett didn't become one of the world's richest men by making spectacular trades. He became wealthy by making good decisions consistently over decades. The same principle applies to trading, regardless of your starting capital. It's not about hitting home runs, it's about getting on base consistently and letting time do the heavy lifting. You don't eat the seed, you plant it, water it, and protect it. This metaphor captures the essence of the compounding mindset. Your $100 account is a seed. It contains within it the potential for tremendous growth, but only if you nurture it properly. If you're constantly digging it up to see if it's growing fast enough, you'll destroy it. In trading, this means resisting the urge to overtrade, to risk too much, or to abandon your strategy when results don't come immediately. The compounding mindset also changes how you view losses. Most traders see a losing trade as a setback, a failure, something that moves them further from their goals. But traders with the compounding mindset understand that losses are simply the cost of doing business. They're inevitable, predictable, and manageable when properly sized. A 2% loss today can be recovered with disciplined execution tomorrow, without taking excessive risk or abandoning the long-term plan. This perspective shift is profound because it removes the emotional charge from individual trades. When you're thinking in terms of compound growth over years, a single loss or win becomes irrelevant. What matters is the collective result of hundreds of decisions made with consistency and discipline. This is how you transform from someone who reacts to every market move into someone who executes a plan regardless of short-term fluctuations. The beautiful thing about the compounding mindset is that it works with any amount of capital. The principles that turn $100 into $1,000 are the same ones that turn $10,000 into $10,000, $100,000. The only difference is the number of zeros. This is why starting small is actually an advantage. You get to practice these principles when the stakes are low and the lessons are cheap. By the time you're ready to trade larger amounts, the mindset is already ingrained. Richard Dennis, the famous commodities trader, proved this concept in the 1980s with his turtle trading experiment. He took a group of people with no trading experience and taught them a simple system based on disciplined rules and risk management. Many of them went on to make millions. The key wasn't complexity or secret knowledge. It was the ability to follow rules consistently over time, even when emotions scream to do otherwise. This is where most traders fail. They understand the concepts intellectually but struggle with the emotional execution. They know they should risk only 1% per trade, but when they see what looks like a sure thing, they risk 5%. They know they should stick to their plan, but when they hit a losing streak, they abandon their strategy and start chasing different setups. The compounding mindset isn't just about mathematics. It's about emotional discipline applied consistently over extended periods. The market has a way of humbling even the most confident traders. You can study every indicator, memorize every pattern, and still find yourself staring at a red account balance, wondering where you went wrong. This happens because most traders focus on the wrong battle. They think trading is about predicting price movements when it's actually about predicting your own behavior under pressure. When you risk money you can't afford to lose, every trade becomes a life or death situation in your mind. Your heart races when positions move against you. Your palms sweat when you see profits that could disappear at any moment. This physiological response clouds your judgment and turns what should be calculated decisions into emotional reactions. The trader with the $100 mindset never risks money that would cause this kind of stress response. Professional poker players understand this concept intuitively. They never play at stakes that make them emotionally invested in individual hands. They know that once emotions enter the equation, logic exits. The same principle applies to trading. Your position size should be small enough that losing doesn't trigger an emotional cascade that affects your next decision. This is why starting with $100 is actually a strategic advantage. It forces you to develop emotional discipline before you have enough capital to do serious damage. You learn to make decisions based on probability and process rather than hope and fear. These skills become invaluable when you eventually trade larger amounts because the psychological foundation is already solid. Most traders skip this developmental phase. They start with larger amounts, experience immediate emotional volatility, and never learn to separate their self-worth from their trading results. They become addicted to the adrenaline rush of big wins and the crushing disappointment of significant losses. This emotional rollercoaster eventually destroys their ability to think clearly and execute consistently. The $100 mindset teaches you to find satisfaction in process rather than outcome. You celebrate following your rules perfectly, even if the trade loses money. You feel disappointed when you break discipline, even if the trade happens to be profitable. This inversion of traditional thinking is what separates professional traders from gamblers dressed up as investors. Think about how this applies to your daily trading routine. Do you feel more excited about a winning trade or about executing your strategy flawlessly? Do you spend more time analyzing your profits or reviewing your decision-making process? These subtle differences in focus determine whether you're building skills that compound over time or simply riding an emotional wave that will inevitably crash. The compounding effect works on more than just money. It works on confidence, discipline, and skill. Every trade you execute according to plan builds your trust in the process. Every time you resist the urge to overtrade, you strengthen your patience muscle. Every loss you accept gracefully increases your emotional resilience. These psychological gains compound just like financial returns, creating a trader who becomes more valuable to the market over time. But here's what most people miss about compounding. The early stages feel painfully slow because you can't see the momentum building beneath the surface. You're making $3 per week on your $100 account, while others are posting screenshots of $1,000 days. The temptation to abandon your disciplined approach becomes almost unbearable. This is precisely where most traders quit and why consistency is so rare in this business. The traders who survive this phase understand that they're not just growing capital, they're building character. They're developing the mental toughness required to handle larger sums without losing their composure. They're learning to find fulfillment in the daily practice of excellence, rather than the intermittent reinforcement of big wins. Consider what happens when you finally scale up to larger amounts. If you've spent months or years practicing perfect risk management with small positions, managing larger ones feels natural. Your emotions remain stable because you've trained yourself to focus on percentages rather than absolute dollar amounts. A 2% loss feels the same whether it's $2 or $2,000 because you've conditioned your mind to think in terms of process rather than outcome. This psychological preparation is why many traders who start with significant capital struggle more than those who work their way up gradually. They skip the character-building phase and jump straight into high-stakes emotional chaos. Without the foundation of disciplined habits, they make impulsive decisions that compound into catastrophic losses. The $100 account becomes a laboratory for testing not just strategies, but psychological responses. You discover how you react to winning streaks and losing streaks. You identify your emotional triggers and develop techniques for managing them. You learn which times of day you trade best and which market conditions suit your temperament. This self-knowledge becomes more valuable than any technical analysis because it allows you to work with your natural tendencies rather than against them. Successful traders often describe a moment when everything clicked. Not a technical breakthrough, but a psychological one. They stopped trying to force the market to give them what they wanted and started working with what the market was willing to offer. This shift from demand to acceptance transforms trading from a struggle into a collaboration. The market becomes a partner rather than an adversary. This transformation rarely happens with large accounts because the financial pressure creates too much noise. The $100 account provides the quiet space necessary for deep learning. Mistakes are affordable. Experiments don't threaten your financial security. You can focus purely on development without the distraction of significant financial consequences. The patience required for this approach runs counter to everything modern society teaches about success. We're conditioned to expect immediate results, instant gratification, and rapid progress. Trading demands the opposite. It requires the ability to delay gratification for months or years while building skills that may not show obvious results until much later. This delayed gratification muscle becomes increasingly valuable as your account grows. The ability to wait for perfect setups rather than forcing trades becomes worth thousands of dollars. The discipline to take partial profits rather than hoping for maximum gains protects you from devastating reversals. The patience to rebuild slowly after losses prevents the revenge trading that destroys careers. Most traders never develop these qualities because they start with amounts that make patience feel expensive. They feel pressure to make significant progress quickly, which leads to poor decisions that compound into larger problems. The $100 mindset removes this pressure and allows natural development to occur at its own pace. The beautiful irony is that the slower you try to go at first, the faster you ultimately arrive at your destination. The trader who spends a year perfecting their process with small amounts often outperforms the trader who jumps straight into large positions within a much shorter time frame. Patience in the beginning creates speed later. Haste in the beginning creates obstacles that can take years to overcome. This principle extends beyond individual trades to entire trading careers. The most successful traders often describe their early years as slow and methodical. They focused on learning rather than earning. They prioritized skill development over profit maximization. This foundation allowed them to handle larger opportunities when they eventually appeared. The $100 mindset also teaches proper relationship with money itself. Many traders have unconscious beliefs about money that sabotage their success. They believe they don't deserve wealth, or they feel guilty about profiting from market movements, or they associate money with negative emotions from their past. These psychological blocks become obvious when trading small amounts because there's less ego attached to the outcome. Working through these money-related issues with small amounts is like therapy that pays you. You discover your limiting beliefs in a low-risk environment and have the opportunity to rewire them before they can cause serious financial damage. The trader who resolves these internal conflicts with a $100 account is prepared to handle much larger sums without self-sabotage. This psychological work is often the difference between traders who achieve temporary success and those who build lasting wealth. Technical skills can be learned relatively quickly, but psychological mastery takes years of consistent practice. The $100 account provides the perfect training ground for this deeper development. The market rewards psychological strength more than intellectual brilliance. It favors emotional stability over analytical prowess. It pays consistency more than creativity. These are skills that can only be developed through experience, and that experience is much more affordable when you start with smaller amounts. The transformation from amateur to professional trader happens gradually, then suddenly. You spend months feeling like you're making no progress, questioning whether you have what it takes, wondering if you should quit. Then something shifts. The charts start making sense, your emotions stabilize, your results become consistent. This breakthrough moment is the compound effect of all your previous efforts finally reaching critical mass. But most traders never reach this breakthrough because they quit during the difficult middle phase. They abandon their process right before the compound effect kicks in. They walk away from the laboratory just as the most important experiments are about to yield results. This is the tragedy of trading. Not that people fail, but that they fail so close to success. The $100 mindset forces you to confront this impatience directly. When your entire account is worth less than a dinner out, you can't rely on luck or large position sizes to mask poor decision-making. Every trade matters. Every decision is magnified. This intensity creates an accelerated learning environment where skills develop faster because consequences are immediate and undeniable. Think about the last time you made a trading mistake with a larger amount. Maybe you held onto a losing position too long because you couldn't accept being wrong. Maybe you moved your stop loss because you convinced yourself the trade just needed more room to breathe. These errors become expensive lessons when you're trading significant capital. But with a $100 account, these same mistakes cost dollars instead of hundreds or thousands. This is where the real education begins, not from books or courses or YouTube videos, but from the market itself. The market is a relentless teacher that never lies, never coddles, and never gives participation trophies. It tells you exactly how good your decision-making is through the only language it speaks. Price movement and account balance changes. The $100 account strips away all the complexity and forces you to focus on fundamentals. You can't hide behind sophisticated indicators or complex strategies. You can't blame your broker or market manipulation. You're face to face with your own psychology, your own discipline, your own ability to execute under pressure. This confrontation is uncomfortable but necessary. Most traders avoid this discomfort by jumping to larger accounts too quickly. They want to skip the character building phase and go straight to the money-making phase. But character and money-making aren't separate phases in trading. They're the same phase. The market pays you in direct proportion to the strength of your character under pressure. Consider what happens when you place a trade with your $100 account. Let's say you risk 2% or $2 on a position. When that trade moves against you by 1%, you're down $1. That dollar represents 1% of your entire trading capital. Your brain registers this as significant, even though the absolute amount is small. This registration is crucial because it keeps you engaged with risk management in a way that larger accounts often don't. Now imagine the same scenario with a $10,000 account. You risk 2% or $200 on a position. When it moves against you by 1%, you're down $100. That $100 might not feel as significant because it's a smaller percentage of your total net worth. This psychological distance can lead to complacency. You might hold the position longer than you should because the pain isn't immediate enough to trigger proper risk management. The $100 account keeps you honest. It forces you to feel every decision in real time. This heightened awareness accelerates learning because feedback is immediate and emotionally registered. You develop an intuitive sense of risk that can't be taught through theory alone. You learn to recognize the difference between acceptable risk and reckless gambling through direct experience. This experiential learning extends to every aspect of trading. Position sizing becomes intuitive when you've felt the impact of getting it wrong with real money. Entry timing improves when you've experienced the frustration of premature entries multiple times. Exit discipline develops when you've watched profitable trades turn into losses because you got greedy or hopeful. The beautiful thing about learning these lessons with small amounts is that the knowledge transfers perfectly to larger accounts. The trader who has mastered risk management with $100 can apply the same principles to $10,000 or $100,000. The psychological skills scale seamlessly because they're based on percentages and processes rather than absolute dollar amounts. But here's where most traders make their biggest mistake. They assume that once they've grown their $100 account to $500 or $1,000, they've graduated and can abandon the principles that got them there. They start taking larger risks because the account can handle it. They become less selective with their trades because they have more room for error. This is exactly backward thinking. The principles that work with small accounts work because they're sound principles, not because of the account size. Risk management, patience, discipline, and emotional control don't become less important as your account grows. They become more important. The stakes get higher, not lower. The most successful traders are those who never abandon their small account mentality. They continue to think in percentages rather than dollars. They maintain the same discipline with $100,000 that they had with $100. They never let account size become an excuse for sloppy execution or emotional decision-making. This psychological consistency is what separates temporary success from lasting wealth. Many traders experience periods of profitability only to give it all back when they start trading differently because they have more capital. They mistake account growth for skill development and change their approach at the worst possible time. The $100 mindset prevents this trap by establishing non-negotiable principles that apply regardless of account size. You risk the same percentage per trade whether you have $100 or $100,000. You wait for the same quality setups whether you're trading microlots or standard lots. You maintain the same emotional discipline whether you're making $3 per week or $3,000 per week. This consistency creates compound growth that extends far beyond simple mathematical returns. Your confidence compounds as you prove to yourself that you can execute your plan under any conditions. Your intuition compounds as you accumulate experience making decisions under pressure. Your reputation compounds as you develop a track record of consistent performance. The market begins to feel different when you approach it with this level of consistency. Instead of feeling like you're fighting against chaotic forces, it starts to feel like you're working with natural rhythms. You stop trying to impose your will on price movements and start responding to what the market is actually offering. This shift from force to flow is subtle but profound. It changes not just how you trade, but how you feel while trading. The constant stress and anxiety that characterizes most traders' experience gets replaced by calm focus and patient observation. Trading becomes less exhausting because you're working with the market's energy instead of against it. The $100 account teaches you to appreciate this flow state because you can't brute force your way to profits with small capital. You have to become more sensitive to market conditions, more precise with your timing, more selective with your opportunities. These skills, once developed, make you a formidable trader regardless of account size. Most traders never develop this sensitivity because they rely on position size to compensate for poor timing and selection. They take mediocre setups with large positions, hoping to make up for quality with quantity. This approach might work occasionally, but it's not sustainable. Eventually, a few bad trades wipe out months of profits. The disciplined approach taught by small account trading is exactly the opposite. You take fewer trades, but each one is carefully selected and properly sized. You might trade only once or twice per week, but those trades have a high probability of success because you waited for optimal conditions. This patience becomes increasingly valuable as markets evolve and opportunities become more competitive. The trader who has learned to wait for perfect setups has a significant advantage over those who feel compelled to be constantly active. They avoid the majority of losing trades simply by not taking marginal opportunities. The waiting itself becomes a skill. Most people think of waiting as passive, but in trading it's highly active. You're constantly analyzing conditions, evaluating potential setups, and preparing for opportunities that may or may not materialize. This active waiting sharpens your market awareness and improves your ability to recognize genuine opportunities when they appear. Professional traders often describe trading as hours of boredom punctuated by moments of intense activity. The $100 account teaches you to embrace the boredom rather than fighting it. You learn that doing nothing is often the most profitable action you can take. This counterintuitive truth separates professionals from amateurs who feel they must be constantly doing something to justify their time. The psychological benefits of this approach extend far beyond trading. Learning to wait patiently for the right opportunity, to resist impulses for immediate gratification, and to maintain discipline under pressure are life skills that improve every area of your existence. Trading becomes a form of meditation that teaches you about yourself while potentially building wealth. The $100 mindset isn't about the money. It never was. It's about who you become in the process of respecting small beginnings, embracing patience, and building character one disciplined decision at a time. The market doesn't care about your account size. It only cares about the quality of your mind under pressure. When you master that with $100, you've mastered the only thing that truly matters. The rest is just mathematics.